What is happening, y'all? Welcome back to the Mining Pods earnings call live stream series. I've got Penny Ether here on the horn with me. We're going to be breaking down Riot's 2024 full financial year earnings here shortly. Penny, how you doing?
Doing well, thank you. How are you?
Doing good, man. Thanks for hopping on. Always love having you on to digest some of these numbers and come with your insights. So this earnings call should start shortly. It's about 2 minutes out according to their schedule. And we'll be live streaming the full thing. We'll hop off and then hop back on for a post call analysis. Penny, before we start, just what are some of the things that you're keeping an eye on for these earnings for Riot? Like, what are some of the things that you want to see from them? What are you expecting?
So I posted my thoughts on my latest or one of my latest Twitter posts, but basically I don't think there's going to be too big of a surprise here. I think the big question is what their costs to mine are. So, and that primarily falls into two buckets, which would be their cost of revenue. So they have like direct power expenses, and then they have all these other expenses as well. Then their SG&A, and I take out stock-based comp. I just want to see what they pay in cash for their SG&A. So the question is how those things are scaling against their hash rate growth and the amount of megawatts they're using. So ideally, you want to see SG&A sort of flatten out, but they can continue to add more hash rate or more megawatts. So that'll help their costs. And the same with cost of revenue. There's only so much they can do there because they have to pay for power, and that scales with how many watts they use. But there's these other costs in there that are kind of significant, and I'm curious how those are scaling. So I'd just be looking at those two things. If you just take their total cash cost to mine as cost of revenue plus SG&A minus, or you can add the power credits they get back to. So I'm just going to look at that number. I expect that'll come in at around, forget what I said, like 17 million, 17 and a half. That would be an improvement. And I do have to say the last, this year, each quarter has gotten better and better with hash costs, but they're still like tied for worst place with Mara. So
Yeah,
maybe this quarter puts them ahead. We'll
yeah.
see.
One of the higher hash costs, we more higher than we might expect given their power rate with all of the curtailment credits they can apply. Part of that has to do with, like you said, they just have really high overhead for a lot of these things, and their uptime is also not very good. When we look at their overall earnings, it, in addition to those qualitative things, I think you nailed all of the ones that are probably most pressing for investors. I'm really curious to see how much Jason and the team talk about their HPC evaluation. There's been this activist investor that's been pushing them to look at Corsicana potentially for HPC and AI retrofitting a la Core Scientific. And also, I'd be curious to see, and I doubt they'll talk about this in the call. They probably won't even mention it in the earnings release itself. But I'd be curious to see if they have anything to say about some of these ASIC miner detentions that we've been covering at Blockspace. A bunch of public miners and private miners and brokers have been affected by the CBP holding these ASICs at ports of entry. Be curious to see if they throw their hat in the ring with any analysis right there, because that's really affecting the forward guidance of hash rate expansion for some of these miners. So anyway, all things to keep an eye on, and the earnings call should start shortly. Mr. Foxley, thank you for joining us. How you doing, man?
So guys,
Thank you and I
run.
both.
I'm gonna run real quick to their numbers came out. I'm just gonna crunch the numbers. I'll circle back with you guys after the call, I guess.
Sounds good. Thanks, Penny.
Cool.
Good to see you, Will and Colin.
Good to see you.
Yeah, so Penny and I were just talking, Will, about some of his expectations and some of the things that he's looking out for during this call. The biggest, obviously, would be Riot's hash cost, which is the highest all-in hash cost of one of the highest of all of the public miners. It's second only to Mara, which some people might be surprised about, because if you look at their production updates, right, they advertise very low power cost, right, because of their curtailment credits.
Yeah.
Oh, all right. Call is starting. I'm going to add this to the stage and we'll hop off. Thank you for joining, everyone.
Please note that
Stay around for after the call. We'll have post-call analysis
until the question and answer session begins following the company's presentation of its prepared remarks. Please also be advised that today's call is being recorded. I would now like to hand the conference over to Phil McPherson, Vice President of Capital Markets and Investor Relations at Riot Platforms. Please go ahead.
Thank you, Michelle. Good afternoon and welcome to Riot Platforms' fourth quarter and full year 2024 earnings conference call. My name is Phil McPherson, Vice President of Capital Markets and Investor Relations, and joining me on today's call from Riot are Jason Les, CEO, Colin Yee, CFO, and Jason Chung, Executive Vice President and Head of Corporate Development and Strategy. On the Riot Investor Relations website, you can find our fourth quarter and full year 2024 earnings press release and accompanying earnings presentation, which are intended to supplement today's prepared remarks, and which include a discussion of certain non-GAAP items. Non-GAAP financial measures provided should not be considered as a substitute for or superior to the measures of financial performance prepared in accordance with GAAP and are included as additional clarifying items to aid investors in further understanding the company's fourth quarter and full year 2024 performance. During today's call, we will be making forward-looking statements regarding potential future events. These statements are based on management's current expectations and assumptions and are subject to risks and uncertainties. Actual results could materially differ due to factors discussed in today's earnings press release, in comments and responses made during today's call, and in the risk factors section of our Form 10-K and Form 10-Q, including for the year ended December 31st, 2024, which will be filed later today, as well as other filings with the Securities and Exchange Commission. With that, I will turn the call over to Jason Les, CEO of Riot Platforms.
Thank you, Phil, and good afternoon, everyone. Before we dive into Riot's 2024 results, I would like to reflect on the industry as a whole. When Riot began mining Bitcoin in 2017, the entire network hash rate was just 3 exahash. By 2024, Riot alone grew our self-mining hash rate by 19.1 exahash to a total of 31.5 exahash, while the global network reached an all-time high of over 750 exahash. In January of 2024, the approval of the Bitcoin ETF brought further institutional adoption, resulting in the most successful launch of ETFs ever as measured by AUM. By July of 2024, Bitcoin had become a key topic during the presidential election, and post-election, Bitcoin hit new all-time highs of 75,000 and then 100,000. Riot has been mining Bitcoin since 2017 with conviction in its long-term value proposition. In January 2024, Riot stopped selling Bitcoin produced through our mining activities in order to retain more Bitcoin. Additionally, we purchased Bitcoin for the first time in December 2024, following our inaugural successful convertible debt offering, ultimately adding over 10,000 Bitcoin to our balance sheet over the course of the year, ending 2024 with 17,722 Bitcoin worth $1.7 billion, based on the Bitcoin price of 93,354 as of December 1st, 2024. Our efforts to maximize the value of our unique power assets does not mean we have changed our long-term view on Bitcoin. Riot currently maintains approximately 4% of the global network, and we will continue to pursue a compounding increase in the value of Bitcoin held per share as a key operating metric, while seeking to maximize the value of all of our assets for our shareholders. In 2024, AI HPC demand for access to power resulted in Bitcoin mining power assets being converted into AI HPC use. This has continued into 2025, increasing the value of large-scale sites with secured access to power near major metropolitan areas, sites such as our Corsicana and Rockdale facilities. There is a unique, timely opportunity for Riot shareholders to benefit from the value of our assets and to maximize shareholder value, and I am excited to share further updates on our aggressive pursuit of this opportunity. I would like to start by reviewing Riot's key accomplishments during 2024. We successfully energized the Corsicana facility. Following approximately 24 months of development, Riot successfully energized the 400 megawatt substation, developed 4 buildings, and deployed immersion systems and miners, ending the year with approximately 14 exahash of self-mining hash rate at the Corsicana facility alone. Our Bitcoin yield strategy. In January of 2024, with ETF approvals imminent and the 2024 halving approaching, Riot's decision to retain all mined Bitcoin and focus on increasing Bitcoin per share, i.e. Bitcoin yield, has resulted in a nearly 40% Bitcoin yield in 2024 and more than $100 million in incremental asset value appreciation in 2024 alone. Our convertible senior notes offering. In line with Riot's Bitcoin yield strategy and target to continue to increase Bitcoin held per share, Riot was able to take advantage of favorable market conditions and issue our inaugural convertible senior notes offering. This issuance lowered our cost of capital, expanded our institutional investor base, and proceeds were utilized to acquire Bitcoin and further enhance Bitcoin yield. The block mining acquisition. This was Riot's first acquisition in more than 2 years, and our first business expansion outside of Texas into an attractive new jurisdiction, offering 60 megawatts of current mining operations and expansion opportunities to 305 megawatts and beyond. Finally, the E4A acquisition, our most recent acquisition, which supplements our engineering business while also enhancing our core operating capabilities. For 2025, we expect to grow our Bitcoin mining hash rate by approximately 22%, while aggressively pursuing AI HPC opportunities to maximize the value of our unique assets. We believe that this approach will bring the most value to our shareholders while allowing us to remain flexible as market opportunities continue to present themselves. With a strong balance sheet, a solid operating team, and a management team focused on value creation, I am truly excited at the path we have ahead of ourselves. With that, I would like to now turn the call over to Colin Yee, CFO of Riot Platforms.
Thank you, Jason. I'm excited to present Riot's financial results for the fourth quarter and fiscal year ending 2024. For ease of reference, we have highlighted key metrics on slide 6, which presents a snapshot of key financial and operating metrics for the full year 2024. However, let's just jump into the details on the following slides. During 2024, Riot increased its self-mining hash rate from 12.4 exahash to 31.5 exahash, representing a 154% increase over the course of the year and outpacing the increase in the global hash rate, which rose by 67% in 2024. Furthermore, in 2024, Riot produced 4,828 Bitcoin, 27% lower than the Bitcoin produced in 2023, primarily as a result of the 2024 halving event in April. However, in spite of this April's halving, Riot ended the year producing approximately 16.6 Bitcoin per day as compared to 16.8 Bitcoin per day at the start of the year. In January of this past year, Riot stopped selling Bitcoin produced in order to increase our Bitcoin holdings ahead of the halving. In conjunction with December's convertible notes offering, proceeds from which were used to acquire Bitcoin in the spot market, we have increased Bitcoin holdings per million fully diluted shares from 31.8 to 44.3, representing an increasing Bitcoin yield of 39% for the year. Going forward, we will continue to focus on increasing Bitcoin yield in order to ensure that our shareholders are able to participate in the long-term value creation opportunity that we believe Bitcoin represents. Riot ended 2024 holding 17,722 Bitcoin, an increase of 141% relative to the 7,362 Bitcoin that we held at the end of 2023. And Riot continues to retain 100% of all self-mined Bitcoin. For the full year 2024, Riot reported total revenue of $376.7 million as compared to $280.7 million for 2023, a 34% increase year over year. This increase was primarily driven by higher Bitcoin prices. Gross profit for the full year 2024 was $147.6 million as compared to gross profit of $97.6 million for the full year 2023. Non-GAAP adjusted EBITDA for the full year 2024 was $463.2 million, as compared to non-GAAP adjusted EBITDA of $214 million for the full year 2023. Riot adopted FASB's final standard on crypto assets issued in December 2023, under which Riot now recognizes its Bitcoin held at fair value, and with it, changes in fair value are now recognized in income. As a reference, the Bitcoin price at the end of 2023 was $42,265, and the price at the end of 2024 was $93,354. This resulted in a mark-to-market upward adjustment of $458.7 million for 20. Net income for the full year 2024 was $109.4 million, or 40 cents per share, compared to a net loss of $49.5 million, or 28 cents per share for the full year 2023. Full year 2024 net income includes non-based compensation expense of $125.2 million, unrealized loss on marketable equity securities of $69.5 million, and depreciation and amortization of $212 million. As a reminder, beginning in the first quarter of 2024, we adjusted our depreciation schedule for mining hardware from a 2-year to a 3-year schedule based on our evaluation of our own operational history. For the full year 2024, Bitcoin mining revenue totaled $321 million, a 70% increase relative to the full year 2023 Bitcoin mining revenue of $189 million. Bitcoin mining cost of revenue primarily consists of direct production costs of Bitcoin mining operations, including electricity, labor, insurance, and other expenses, but excluding depreciation and amortization. Bitcoin mining gross profit for the quarter was $165.5 million, representing a margin of 52%, as compared to $163.6 million, or a margin of 80% for the full year 2023. Cost to mine, excluding depreciation, in the fourth quarter totaled $42,011 per Bitcoin, of which power costs amounted to $33,281 per Bitcoin, or 79% of total cost per Bitcoin. Quarter over quarter, power costs increased from 3.1 cents a kilowatt hour to 3.8 cents a kilowatt hour, as a greater proportion of our power was procured at the Corsicana facility at spot market rates, which at the times purchased were, on average, elevated relative to the fixed rate under PPAs at the Rockdale facility, with proportionally fewer offsetting power credits than in the previous quarter. For the full year 2024, we achieved an all-in cost of power of 3.4 cents a kilowatt hour, which remains one of the lowest in the industry. Direct non-power costs, which include direct labor, miner insurance, miner and miner-related equipment repairs, land lease and related property taxes, network costs, and other utility expenses totaled $8,730, or 21% per Bitcoin, down from the third quarter of 2024, when direct non-power costs accounted for 25% of total costs. This drop is a result of Riot continuing to achieve economies of scale at our operating facilities. As Riot continues to grow hash rate, we expect to see non-power direct costs as a percentage of the total cost per Bitcoin to trend lower. I'd now like to turn the call over to Jason Chung, Riot's EVP and Head of Corporate Development and Strategy, to discuss our most recent acquisition.
Thanks, Colin. I'm excited to share information on Riot's latest acquisition. This past December, we closed the acquisition of E4A Solutions for $52 million in cash consideration at closing. E4A Solutions, based in Houston, Texas, is a leading provider of consulting, commissioning, and procurement services designed to support electrical project needs for substations, from low voltage to high voltage. E4A employs approximately 50 employees and services power plants, transformers, substation equipment, and switchgears for a blue-chip roster of clients which include First Energy, Hitachi, Hyundai, and Toshiba, among many others. In 2024, E4A generated $28.2 million in revenue, a 31% increase over 2023 revenue of $21.5 million, and $4.6 million in EBITDA, representing margins north of 16%. The acquisition of E4A Solutions offers a number of strategic benefits for Riot and significantly bolsters our engineering business. More specifically, our engineering business, ESS Metron, will now have the ability to add higher margin, recurring services revenues to customers. E4A's services expertise in maintenance, servicing, training, and repair can now be offered on equipment manufactured by ESS Metron, while the countercyclical profile of the services business relative to ESS Metron's business is also expected to reduce overall revenue volatility in our engineering business going forward. With this acquisition, Riot has now brought in-house expertise in developing, maintaining, and servicing medium and high voltage substations, which will further de-risk infrastructure development and save costs, while also improving our ability to perform on-site maintenance on switchgears, and most importantly, leading to further improvements in operating uptime for our Bitcoin mining business. In 2024, Riot's engineering business generated $38.5 million in revenue, down from $64.3 million in 2023. This reduction in top-line revenue was largely driven by one large manufacturing contract for a governmental entity, which took longer than anticipated to complete due to supply chain constraints during the year, which resulted in decreased receipts of materials and delayed recognition of revenue. The custom electrical products manufactured by Riot's engineering business, such as switchgear and power distribution centers, are particularly important components in data center development and in power generation and distribution facilities. And there has been a significant increase in demand for these products due to the continued increase in AI HPC data center development and the continually increasing demand for power. With our now expanded engineering business, products, and services capabilities, Riot is well positioned to capitalize on this growing demand, and alongside the recent acquisition of E4A Solutions, has a clear path towards reaching $100 million in revenue in 2025, while also increasing meaningfully. With that, I'd now like to turn the call back over to Jason Les.
Thank you, Jason. Now, I'd like to turn the presentation to Riot's treasury strategy. Riot continues to hold all of its self-mined Bitcoin. In 2024, holding all of our Bitcoin versus selling at the time it was mined resulted in an increase of $120 million in value. Our bullish belief in Bitcoin has not wavered, and we believe that holding Bitcoin, increasing Bitcoin yield, will result in greater shareholder value over time. This slide demonstrates the delta we achieve on holding Bitcoin production over the year versus selling it at various end-of-year Bitcoin prices. One of the tenets of Riot's strategy has been to maintain a strong balance sheet, underpinned by our growing Bitcoin balance since 2018. This has allowed Riot to act opportunistically and grow our portfolio of assets, which in turn has created the new opportunity set that we are executing on today. While Riot has always been conservative with regards to long-term debt, the increased value of our Bitcoin and the attractive terms in the convertible debt market led to our inaugural debt issuance in December 2024. We viewed this as a method to utilize our strong balance sheet to acquire more Bitcoin at an attractive cost of capital. Our internal policy is to not take on additional debt such that doing so would exceed a 40% debt to Bitcoin value ratio. We feel this limit on leverage is prudent and allows us to create additional value for our shareholders. Further, as we continue to increase our Bitcoin balance every month by retaining production from our mining operations, we are organically deleveraging over time. For 2025, Riot anticipates capital expenditures totaling $198 million. While we have halted the Bitcoin mining expansion at Corsicana, existing expenses, primarily consisting of the 600 megawatt substation development, continue. Additionally, we continue developing the various facilities that comprise our Kentucky operations, including $23 million on infrastructure expense and $110 million on miners. However, it's important to note that $35 million of that is for deposits for hash rate coming online in the first half of 2026. As a result of these investments and our efforts on the ground, we expect to end 2025 with 38.4 exahash in deployed hash rate, a 22% increase over the 31.5 exahash we ended the year 2024 with. We expect this to approximately match the pace of global network hash rate growth this year, maintaining our approximate 4% share of the overall network. In 2024, the rapid growth of AI applications and the resulting increase in demand for large-scale access to power needed for large language models and inference compute became a dominant market theme. We have long viewed our Bitcoin mining business as being at the forefront of the convergence of energy and sound money. With the emergence of AI HPC, we now find ourselves at the center of the convergence of energy and high-performance compute. As such, Riot's uniquely positioned portfolio of high-quality energy assets can now be viewed through a wider lens. The core of Riot's strategy has been to take a vertically integrated approach to securing, developing, and operating energy infrastructure for Bitcoin mining. This focus has led to Riot owning and operating two premier power assets, which now form the basis for the expanded opportunity set uniquely available today to explore all opportunities available to us to maximize the value of energy assets across our portfolio. The market has already taken notice of the value of AI HPC contracts and has rewarded those companies which have made this pivot with elevated valuation multiples. The chart on page 21 demonstrates both the valuation multiple expansion some of our public peers have experienced as they have pivoted parts of their power assets to also include AI HPC, as well as the lagging valuation multiple seen by the remaining Bitcoin mining pure play players. While revenues from Bitcoin mining can exhibit volatility in the near term, AI HPC contracts offer long-term predictable cash flows with credible counterparties, which can reduce the overall volatility in our financial performance and to which the market assigns higher valuation multiples. One of the most active themes we see in the market today relates to the significant need for power faced by the major hyperscalers in their arms race to deploy more high-performance compute capacity and the associated capital expenditure plans they committed to in order to achieve their goals. Microsoft, Meta, and Alphabet alone have collectively committed to more than $200 billion in spending plans this year, with the rest of the industry closely following suit. In order to meet their aggressive growth targets, hyperscalers face immediate need for large-scale access to power, with industry forecasts calling for nearly 30 gigawatts of additional power demand over the next 5 years. As I will get into, Riot has a clear and unique opportunity to capitalize on this tremendous demand imbalance. As hyperscalers continue to search for large-scale access to power, they particularly prioritize 3 key attributes. 1, proximity to major markets. 2, speed to market to deploy compute quickly. And 3, large-scale access to power in the hundreds of megawatts. Riot's primary assets in Rockdale and Corsicana are particularly well-suited to satisfy each of these key requirements, which I will get into shortly. We believe the Corsicana facility offers the most compelling opportunity available today for a hyperscaler to get immediate access to large-scale power, all in close proximity to Dallas, one of the most sought-after data center markets in the country. This gives hyperscalers access to existing connectivity hubs and lower latency. Most importantly, Corsicana has 400 megawatts of power that can be utilized today, and we're actively developing an additional 600 megawatt substation to be ready in early 2026. Combined, this is 1 gigawatt of power that can be available for a hyperscaler to deploy almost immediately, which when combined with its location, we believe makes Corsicana an extremely rare offering. In addition, we own the land at Corsicana. We have access to water with that access growing further, and multiple redundant sources of fiber available today. These are the key criteria hyperscalers are first looking at when evaluating sites, and we think Corsicana is extremely well suited. For many of the same reasons Corsicana is uniquely well positioned to attract hyperscalers, we believe that Rockdale represents an exciting opportunity as well. At Rockdale, we have a 700 megawatt substation already developed and capacity that can be made immediately available. The current Rockdale site spans more than 200 acres, most of which is cleared open land, which a hyperscaler could begin immediate development on in order to take advantage of this large-scale access to power. Similar to Corsicana, Rockdale is located just 45 miles from Austin, which also represents a major data center market which hyperscalers are seeking proximity to. We also believe the relatively short distance between the Rockdale and Corsicana facilities at about 100 miles creates another compelling opportunity for one hyperscaler to deploy up to 1.7 gigawatts of power across the two sites that are not only in close proximity to each other, but to two major data center markets. Late last year, Riot began to receive inbound inquiries from hyperscalers interested in exploring opportunities related to our power assets. And as these discussions progressed, it became clear to us that there was a significant opportunity at hand. As a result, and since then, we have taken a number of steps to capitalize on this tremendous opportunity presented to us. First, this past January, we engaged Altman Solon, a leading telecommunications strategy consultancy, to help us conduct a study to evaluate the feasibility of utilizing our Corsicana site for AI PC uses. This study has now been underway for a number of weeks and is expected to conclude next month. Second, earlier this month, we made meaningful changes to our board of directors with the addition of 3 new independent directors and the expansion of our board to include 6 directors in total. The new independent directors who have joined our board come with a unique set of skills, including significant data center development expertise, deep real asset development, capital allocation experience, and broad corporate governance experience. Our newly constituted board will continue to oversee and advise the management team on this and other key initiatives at Riot. Third, we have engaged Evercore and Northland as our financial advisors to advise us on engaging with potential AI HPC partners in a value maximizing approach. Both firms have significant experience and strong relationships with hyperscalers, data center developers, and financing partners, and in advising companies like Riot. Fourth, although we previously announced a halt to the phase 2 expansion of Bitcoin mining at our Corsicana facility, it is important to highlight that we continue to develop the additional 600 megawatt substation on site to ensure that we enhance the attractiveness of the site to hyperscalers and data center operators. We are taking concrete steps to ensure that we are maximizing the value of the opportunity available to us today, and will provide further updates on our progress as they occur. As a result of the foundation we have built over the previous years, we believe that 2025 will be an exciting and rewarding year for Riot shareholders. we are dedicating a tremendous amount of resources towards executing on AI HPC opportunities. We also continue to remain focused on increasing Bitcoin yield, driven by our Bitcoin mining operations and prudent capital strategy. Underpinning our mining operations is our industry-leading low cost of power, which Riot continues to demonstrate exceptional results over a now multi-year track record. For the past few quarters, we have talked about our focus on operational efficiency, and the results of these efforts have taken shape over the past few months, as demonstrated in our monthly production results. Operational excellence continues to be one of our priorities, and our teams are hard at work to drive top-tier results. In closing, myself and the rest of the Riot team could not be more excited about the direction the company is heading. We have the assets, the capital, and the right team to execute on significant growth of shareholder value. Thank you all for listening to our presentation. We would now like to open the call to questions. Operator.
Thank you. If you'd like to ask a question, please press star 11. If your question has been answered and you'd like to remove yourself from the queue, please press star 11 again. Our first question comes from Greg Lewis with BTIG. Your line is open.
Yes, thank you, and good afternoon, and thanks for taking my questions. Jason, thank you for the presentation. Definitely a little more insightful than in previous quarters. I guess my first question is around the HPC opportunity, and I know we've been talking about this on and off for a while now, but as you look at the landscape, I think from going back to last year, there was always this expectation of a requirement of prompt power, where there was a window. As you've engaged and had increasing conversations with more hyperscalers, are you seeing that window potentially widening, i.e., hey, it's great to have prompt power in 2025, but having power in further out years is almost just as valuable?
Yes, Greg. I think the power is extremely valuable in 2025, but any power available, including in 26 and in 27, is extremely valuable as well. As highlighted in the presentation, you're looking at about 30 gigawatts of AI HPC demand. That's just AI HPC demand alone over the next 5 years. Transmission, new interconnects take 4 or 5 years to get approved. Log lead substation items, those are taking 4 to 5 years to get shipped now, and transmission cannot keep up with the growth. So capacity in 2025 commands a real premium, which is why we think our assets are so valuable, both with hundreds of megawatts available today and continuing to grow into 2025. Real looking for a solution to, and Riot is very well positioned to be that solution for hyperscalers.
Okay, great. Thank you for that. And then the other question is, obviously we're engaging with, hyperscalers in signing up, or potentially signing up HPC transactions. What is there kind of a dual process, i.e., is Riot's kind of talking with EPCs and some of the companies or suppliers that would help build these facilities, or is it kind of let's get the hyperscaler in first and then figure out, kind of let them lead the build out of the conversion or the build out of the greenfield site?
Greg, I'd say we have multiple tracks going on at once. There's a number of ways that these opportunities can materialize, and we're keeping our options wide open in order to make sure we get the value maximizing approach. We've received interest from hyperscalers and large AI companies. These discussions have been ongoing with our new financial partners. We're now reaching out to additional infrastructure partners and financing partners as well. So a lot of going on in the mix, and where we're going to end up to is the path that maximizes value after surveying kind of the whole market here. But as I highlighted, in parallel, we're continuing to build out the capacity at the site. We're pursuing on what would be the first stage of the development anyways. So I would say multiple tracks being run down at once.
Okay, super helpful. Thank you, guys. Have a great day.
Thank you, Greg.
Thank you. Our next question comes from Nick Giles with B. Riley Securities. Your line is open.
Thanks, operator. Good afternoon, everyone. My first question is, as hyperscalers race for readily available capacity at scale, there's a clear desire to build large-scale campuses, and this does require significant amounts of land. So I was curious to what extent Corsicana could accommodate additional capacity beyond the targeted 1 gigawatt, or based on your earlier comments, could Rockdale be better positioned from this perspective? Thanks very much.
So we think the Corsicana is an amazing site because it has the 1 gigawatt interconnect approved. It has the power capacity available today. It's expanding. We have dual sources of fiber, water, close to a major data center market. We're really excited about what Corsicana can mean in these discussions. So when you think about land for AI HPC developments, there's kind of a spectrum of which these things can take, and that impacts design decisions. The more land you have, generally, the cheaper it is to build, the easier it is from a layout and cooling perspective. The less land you have, the more next generation kind of rack and cooling technologies that you end up using that can kind of be more expensive. But nonetheless, we have you noted we have a lot of land at Rockdale. We have a good amount of land at Corsicana, and we are expanding land portfolio at Corsicana right now as well. And the final point I'll make is oftentimes when hyperscalers are talking about campuses, they don't always generally mean they are directly adjacent to each other. Sometimes they are, sometimes up to 100 miles apart. So we are increasing our land portfolio in order to increase the optionality of what we can do here in this endeavor.
Jason, that's super helpful. I appreciate those comments. My next question was, we've seen economics vary to some degree in the deals that have been announced. So what's your main priority as you think about terms of any potential HPC deal? Is it margins, capital contribution, duration, size, or kind of all of the above?
Well, Nick, I'd say a key part to getting a project of this scale done, in the hundreds of megawatts, gigawatts that we're talking about, financing is a key thing. So to be successful at financing, you really need a blue chip counterparty, someone who's very well capitalized, that we would be able to securitize the cash flows on in the best possible terms. And further, we're talking about hundreds of megawatts. That's really only attracting the largest player in the space. So in addition to driving the financing terms, the type of counterparties that we would enter into is really going to have a big impact in driving valuations. So as you can see, one of the key points I'm hammering on that we think about is the type of counterparty is necessary in order to maximize shareholder value here. As far as some of the other terms, there's a whole mix of how all of these things can be played together. I think it's kind of too early to say which one may be more or less important to another. At the end of the day, what's important to note is Corsicana and Rockdale, but specifically Corsicana, is ideally well positioned. We think this is a premier asset that commands a premium for its quality and its timing to getting power online, and that's something obviously that hyperscalers are prioritizing. And that these attributes will ultimately lead to better deal terms that reflect the value of those assets.
Jason, I really appreciate all the color. Continue, best of luck.
Thank you, Nick.
Thank you. Our next question comes from Darren Aftahi with Roth. Your line is open.
Yeah, hey guys, thanks for taking my questions. First, if I may, Jason, on your comments about Corsicana, you talked about procuring additional land. Any kind of indulgence on how large of an additional plot that would be, and is that something that the counterparties you're potentially talking to have kind of asked for?
We have spoken to counterparties. To some it matters, to some it doesn't. like I touched on earlier, it ultimately depends on the type of build out that you're looking to do. The technology with data center development is becoming very efficient with density. We're on to 100, 200 kilowatt racks now, direct chip liquid cooling. All of these components, all of these technologies are improving density. So it kind of depends. Different types of customers have different needs for this land. Nonetheless, our focus is on increasing, maximizing the optionality that we have. So I don't have a specific number for you, but I can tell you we're procuring in the hundreds of acres in order to, just, like I said, make sure we can accommodate as wide a market as possible.
Great. And then one more, if I may, in the deck, you kind of advertising Corsicana, advertising Rockdale, and then you're potentially talking about maybe doing a fiber loop and advertising the whole campus. So I guess as it stands today, Rockdale's always been a Bitcoin mining facility. Is there a scenario analysis economically where you would flip the switch and completely make that an HPC campus? Thanks.
Yeah, if the opportunity was there if there was interest in that site and the economics, made sense to take over the capacity that we had there, we would certainly be interested in that. I think when you think about 30 gigawatts of demand, 1 gigawatt at Corsicana and then 700 megawatts of Rockdale represents a really meaningful portion of something that could fulfill that demand. 1.7 gigawatts would be about 5%. If someone had both of those sites, 5% of hyperscaler AI demand over the next 5 years. I think that would give those players a real strategic advantage. So if there is that interest and the economics are there to convert that site, we will certainly be looking and evaluating that closely.
Great. Thanks, Jason.
Thanks, Darren.
Thank you. Our next question comes from Brett Knoblauch with Cantor Fitzgerald. Your line is open.
Hi, guys. Maybe my first question, similar to the last, is all of Corsicana on the table if a hyperscaler wanted the full gigawatt there?
Well, we have the 600 megawatts that's being unutilized, that's being developed right now. That would be the least friction way to accomplish a deal, Brett. But if there was someone that was interested in the full 1 gigawatt, taking over the entire site as it is, and have the economics to make that accretive to Riot shareholders, yeah, we would definitely look at that. And that it's always possible that presents itself because that's a lot of power coming online. 400 megawatts now, and then the remaining 600 megawatts 12 months from now, or approximately 12 months from now. So, we're assessing demand, and we are going to maximize the value of these assets.
Understood. And then maybe just on the power agreement in place at these sites, do they need to be altered to support AI HPC? And maybe in particular with Rockdale, does your participation in a lot of the demand response and curtailment programs, does that need to switch from maybe a flex load to firm load?
No, they do not need to be altered. Our power supply agreements do not require any participation in demand response. Everything we do there is voluntary as a part of our power strategy. That works with Bitcoin mining because it's an interruptible load. Obviously, that doesn't work with AI HPC. So we do that with Bitcoin mining voluntarily to drive the best economics, but not a requirement as a part of our power supply agreements.
Perfect. Thanks, guys. Really appreciate it.
Thanks, Brett.
Thank you. Our next question comes from Reggie Smith with JPM. Your line is open.
Hey, guys. Thanks for taking the question. Congrats on the quarter and the year. Had a question. I was looking at your OpEx trends, and I don't want to rain on any parade or anything like that, but notice, we look at SG&A minus stock comp, and we've seen that number grow sequentially each quarter. Sounds like you've done some acquisitions. There may be some deal costs in there, but what's driving that? How are you benchmarking OpEx growth and things of that nature? And I was curious if you had an employee count, because I was trying to calculate stock comp per employee. And I got a follow-up. Thank you.
Okay, so working backwards, Reggie, I don't have a exact employee count for you. It will be in the 10K, which should be filed, very shortly here. As far as G&A goes, so our G&A has been elevated both in 23 and 24. Q3 and Q4 2024 due to one-time M&A and legal litigation expenses. They're not recurring expenses for running our business. They're not a part of running a Bitcoin mining operation or AI HPC operation. So that was pretty meaningful in especially Q4. We had approximately 22 million in one-off costs. Like I said, mainly litigation expense. We had some stock-based advisory services that was closing out a 3-year engagement. We had some M&A expenses as well. So obviously, we would like our litigation tied up in a timely manner, so we're not incurring these expenses anymore, and we can get cash SG&A down. And I have an employee count for you, thanks to help in the room here, 783 full-time employees.
Got it. Okay, that makes sense. All right, so it sounds like there is some one-timers. Is it possible to handicap like where you would like that to be, kind of on a run rate or go forward basis, like stripping out all the noise? Like, what do you think you can run? Your Corsicana facility and your Rockdale and everything else you got going on a kind of quarterly basis.
So first, to note how the expenses are allocated, there's a split between direct operating costs. Those are in cost of goods, in addition to power, although power is the biggest expense. And then we have some other kind of more corporate operating expenses, facility-wide expenses that fall under SG&A. But to directly get to your question, we think our 2024 cash run rate quarter is going to be in line to modestly above what our previous Q4 2024 run rate guidance was, which is approximately 30 to 33 million. It's very difficult to anticipate what litigation or one-time maybe M&A items might be, or advisory fees that may pop up. But on a run rate basis, that's what we are looking at per quarter, 30 to 33 million cash. And we're focused on optimizing that, especially relative to our overall hash rate portfolio.
No, that makes sense. Okay, great. And then if I can get one more in, I was curious, the consultants that you've spoken with, have they given you any guidance on like how long it may take to finalize a deal? I'm just kind of thinking through like how quickly something could get done or how long might it drag on. And it sounds like, and maybe I'm reading too much into this, that, if something isn't done by, late 25, then you would then consider going back to kind of Bitcoin mining, expanding your Bitcoin mining operation. Because it sounds like you've given, you feel comfortable with where your hash rate will be relative to the network hash rate. Am I thinking about that right?
Well, I don't think we're thinking of, we need to get, if there wasn't capacity fully spoken for by the end of this year, we would resume Bitcoin mining. I think we're based on the demand and the quality of assets that we have, we're pretty optimistic about getting something done. How long that takes is probably unpredictable from a soup to nuts to completion, but there are going to be steps along this way. Depending on the ultimate deal structure that comes through, multiple steps can include signing a lease, having a development partner, for example, securing financing, for example, and those could occur in a number of orders. So we're really aggressively pursuing this. We want to communicate updates as they occur, but we aren't thinking about this as we need to get this done by X date or we're to go back to Bitcoin mining. We think these assets are really exciting for AI HPC data center development, and we want to get something meaningful done there.
Got it. Great. And I guess, again, I just want to congratulate you guys. I know we had talked previous quarters about improving uptime and operations. You guys have done a good job of that. So I wanted to, acknowledge that. So great job on that. And I look forward for more updates on the HPC side. Thank you.
Thank you, Reggie. Appreciate that. All the credit goes to the guys in the field, guys and gals in the field working hard to improve operations every day.
Thank you. Our next question comes from Mike Grondal with Northland. Your line is open.
Hey, guys. Thank you. 2 questions. The first one, can you provide a little bit more color? I guess my specific question is on the 400 megawatts at Corsicana and the 700 at Rockdale. Have you gotten specific interest for that power yet, or would you say it all kind of so far relates to the 600 megawatts at Corsicana? And then secondly, any operational goals for 25 on the mining side?
So starting backwards with your question there, Mike, operational goals on the Bitcoin mining side, we're looking to increase our hash rate by approximately 22% this year. That's really driven by expansion at our Kentucky facilities. We're focused on operational excellence. We want to continue executing on our power strategy and improving uptime as months goes on. So we have a good amount of work ahead of us to improve that business line as well. And I think we're making all the right moves to show better results there and hit those growth targets in Bitcoin mining and ending the year with 38.4 exahash. As far as the interest in the power, I would say that hyperscalers, large companies, have seen our access to power and they're interested in getting some piece of it. It hasn't, the inquiry has not necessarily been specific as, we want your next 600 or we want the 400 here or anything like that. It's more of, hey, we need power fast. We want to have a conversation with you of how might that work with your assets.
Got it. Okay. Hey, thanks a lot.
Thank you. Our next question comes from John Todaro with Needham. Your line is open.
Hey guys, thanks for taking my question. I have two. So I know it's early days in the convos, and I hear you on all the demand out there and what everyone's expecting. But I think the market is starting to question some of that demand, especially on days like today. So first question is just, as those conversations with hyperscalers have gone, have you noticed any change recently versus maybe a few weeks ago or a month or so ago? Just kind of any tea leaves there? So that's my first question.
We have not seen any change yet. We're expanding the scope of the counterparties we are talking to now in conjunction with our financial advisors, Evercore and Northland, in order to make sure we get the fullest view of the market here. But I think there's been lots of news stories on AI demand and how that's fluctuated. The news about Microsoft today, it seems very quickly that a lot of that was disputed and was a bit misleading or misunderstood information to start. But I'd also point out to developments like Grok 3 is now the #1 rated AI. And how did they achieve the results in that AI? They did a significant amount of pre-training because XAI got 100,000 going on 200,000 NVIDIA GPUs up fast. So even though there's efficiency gains being had or being studied, it still remains that large-scale access to power and then by extension compute gives hyperscalers, gives AI developers an edge in these products. So as long as there's demand for AI, which I only believe is going to continue, I think we're going to continue to see increased demand for power to build data centers to get a competitive edge in that sector.
That's great. And then my next question, so just try and frame it again for us, because I know you guys have made the argument before how the Bitcoin business complements HPC, because I see you're basically doubling down in Bitcoin, especially on Bitcoin on the balance sheet, but then want to aggressively go at HPC, and it seems like, at least from the investors we talk to, like the guys who like HPC don't really like Bitcoin. So do you spin off one of them, or how do they complement each other, I guess?
Well, I'd say today, Riot's basically positioned itself at the center of two rapidly growing industries. We have Bitcoin and we have AI HPC data center demand, which is a very common theme. Bitcoin's rapid rise to institutional adoption and the price appreciation is what has positioned Riot as uniquely one of the handful of companies that has direct exposure to Bitcoin. Our Bitcoin balance, in addition to our Bitcoin mining business, has provided Riot with the framework to raise capital at attractive levels and invest in projects like Corsicana, like growing Rockdale, and that has resulted in the opportunity set today. We think we can create a lot of value from that. So with the AI HPC opportunity, this gives us another way, seemingly better way to use energy assets and generate substantial economics returns. And I think being flexible and opportunistic is what is going to give our shareholders a diversified path to greater returns. So, John, I would say that Bitcoin is the reactor that has grown our business and grown our assets and got us to the point where we could do this. And we believe it's going to continue generating opportunities for us. And having the ability to develop AI HPC data centers or do deals in that sector is just another super exciting way in which we can increase value.
Great. Thanks for that, and congrats on the quarter, guys.
Thank you.
Thank you. Our next question comes from Martin Toner with ATB Capital Markets. Your line is open.
Thank you so much for taking the question. Congrats on the deal and the improved efficiency this quarter.
Thank you, Martin.
Quick question on the deal and the $100 million run rate and the margins. Just wondering, when might you expect this business to produce like industry margins more in line with the industry and more in line with the acquired company?
Thanks, Martin. I'm going to turn that question over to Jason Chung, our EVP and Head of Corporate Development.
Sure. Hi, Martin. Interesting question. We definitely see, if we think about what the engineering business is today, following the acquisition of E4A Solutions, the services business by nature tends to have higher margins. And so we definitely see that higher margin profile demonstrated by their financial performance. They're at the center of this incredible growth we see in demand for power generation and data center development. So we've seen historically their top line continues to grow while they've been able to maintain healthy margins, and we definitely expect to see that continue going forward. And I think that really forms the basis for the sort of high level view we have around 2025 performance on the engineering side. The other part of that, the other component to that is the Metron business, where now that we've gotten this one particular contract behind us, we expect that business to recover meaningfully. And so if you look at where they were, call it in 2023, top line there, similar margins, but now we're combining the E4A business with a top line that's expected to continue to grow strongly this year and maintain healthy margins. Then on a sort of combined pro forma basis, we think that engineering business will show significant improvement in margins. Then as you kind of look out further, we continue to see some really interesting synergy opportunities in combining these two businesses, both on the cost saving side in cross-selling, and even just given the E4A Solutions base in Houston, where we think some of the capacity issues that have currently constrained the ESS Metron business can potentially be alleviated. So I think there's some really interesting near to midterm opportunities to increase that margin profile even further now that we've got the two businesses together.
That's great. Thanks so much. That's it for me.
Thank you.
Thank you. Our next question comes from Patrick Moley with Piper Sandler. Your line is open.
Yes, good evening. Thanks for taking the question. So I have one on the Rockdale site. If I'm not mistaken, I think that you currently lease that site. You don't own it outright like you do with Corsicana. So can you maybe just talk about the specifics of that lease and whether the fact that you lease that land makes it any less attractive to hyperscalers when they're thinking about choosing a site for the data center? Thanks.
Yeah, Patrick. So you are correct. Whereas at Corsicana, we own the land. At Rockdale, we are on a land lease. That is on a pretty long term, though. The initial term is 10 years, and then there are multiple 10-year renewals at our option. I think a total of 40 or 50 years in total on there. So it's a pretty long-term ground lease. I think what would impact deal there is the type of deal that's getting done. I think it depends on what the level of involvement from the customer would be. I think ultimately drives whether or not Rockdale and the fact that the land is leased impacts if it's viable for them. But at the end of the day, the major theme here is constraint on power. And we believe that as that constraint becomes more and more real, and these hyperscalers and AI companies are competing with each other for capacity, factors like that may start to mean less if it means getting capacity on sooner.
Okay, got it. Then just a follow-up, it's obviously going to vary by, the needs of the tenant, but some of the similar deals we've seen get done in the space have been north of 10-year lease terms, 10-year terms on the AI HPC deals. So based on your conversations, can you talk, about how long you think a contract, if you were to sign one, could potentially be? Has that come in at all as some of these questions have arisen about longer term demand? Anything on kind of like the length of some of these deal terms would be great. Thanks.
Yeah, I think long-term demand is, the long term of an agreement is a key point, and that's both for customers and for us. We're going to be building infrastructure. We're going to be spending capital on this, and there are good terms available today. We want a long-term agreement to lock that in and give ourselves the visibility of the financial return for the assets over a long term. So I think both sides are similarly interested in having long-term agreements, 10 years and beyond.
All right, great. That's it for me. Thanks, guys.
Thank you.
Thank you. Our next question comes from Bill Papasanasisu with KBW. Your line is open.
Good evening, gentlemen. Congrats on the deal, and thanks for taking my questions. My first question is with respect to driving higher Bitcoin yield. Curious to hear how the company's thinking about dilution going forward to drive a higher Bitcoin per share. And could we see Riot issuing other forms of structured products down the road?
So minimizing dilution is a key part of being successful at Bitcoin yield. The core part that drives it for us as a Bitcoin miner is our mining operations, where we're achieving a very low direct cost of production. That is what is the basis that forms how we organically generate Bitcoin yield. And of course, we're always going to be looking to raise capital in the least dilutive, lowest cost of capital manner in order to enhance Bitcoin yield. And it's a reason why this metric is powerful. We think it helps hold teams such as ourselves accountable to making dilution as minimal as possible. So that leads to how we think about going into the market with equity. You'll notice over the past few months or so, we've been very light with our ATM program. It also is what drives us to find additional forms of financing. We think with our assets and the things that what we build up here at Riot, we are well positioned to find alternative forms of financing. All of this contributes to driving a Bitcoin yield. As far as other kind of structured products, I assume you're alluding to the things that like what a Strategy has done. That's not something that we've looked too closely at yet. Our main focus has been the AI HPC opportunity right now, but I think we'll closely monitor how these products come about and see what investor and market demand looks like for them.
Appreciate that color. And then secondly, and apologies if I missed this earlier in the call, but can you share some more color on how the design and engineering aspect of the AI HPC data center could look like? Will you need to hire or partner with more external parties to get it up and running? Curious to hear what the plan is there. Thanks.
So I think it'll ultimately depend, Bill, on the type of deal that comes together. Like we talked about earlier, we want to pursue what maximizes the most value on a risk-adjusted basis. And there's multiple different avenues in which we can execute there. In some of these avenues, we already have a team in place to do that. We're building out our power capacity very well. We've been exceptionally good at that, and the acquisition of E4A makes us even better at building out what you would say is the powered shell of an infrastructure of a data center development. Further, Riot and Bitcoin mining, well, we've developed our infrastructure there with state-of-the-art cooling techniques techniques, and that experience translates into supporting data center development, especially with the type of state-of-the-art cooling techniques we're seeing there. So I think we have a good amount of talent. Nonetheless, we are focused on bringing on additional help to support an execution there, and we're working on that from both an internal and a third-party perspective.
Awesome. Thanks for the color. Looking forward to the feasibility study next month.
Thank you, Bill.
Thank you. Our next question comes from Joe Flynn with Compass Point Research and Trading. Your line is open.
Hi, thanks for the question. I was wondering, maybe based on early conversations with your, consultants, if there's any operational metrics you can share, such as, ultimately what PUE you'll be able to deliver at and your build cost per megawatt, and how that could be different between the 600 megawatts at Corsicana and the Rockdale site, given, there's already existing power infrastructure in the ground. Thanks.
Yeah, I think it's probably too early to comment on what PUEs could look like, especially since the technology is changing so rapidly, and it's going to depend a lot on what the type of customer would be. I think both Rockdale and Corsicana are in very similar climates, only being 100 miles from each other. So they would be similar on both sites. At both sites, though, we have very sufficient access to water, especially at Rockdale. So we have the ability to support a wide variety of cooling technologies there. So, Joe, I couldn't tell you what it would be like just yet. I think the conversations would need to advance further. We'd have to be kind of in the design phase to know what that particular customer is looking to accomplish.
And then just, going back to just, maximizing the value of the sites, does that include potential, outright sales, of capacity? And on that front, have you been approached or even gotten offers for, an outright asset sale?
There's a whole spectrum of potential deal structures here. It could be on one end, it could be leased land, it could be a powered shell, it could be building something to suit, basically a large complete data center. And then the biggest end of the spectrum would be an outright sale of the asset. So we're open to all of these as we progress in discussions here. And we want to drive a strong competitive process here, and why we've engaged Evercore and Northland to give us the most broad penetration to the market we can.
Great, thanks.
Thanks, Joe.
Thank you. That's all the time we have for questions. I'd like to turn the call back over to Phil McPherson for closing remarks.
I'd like to thank everybody for tuning in today to our earnings conference call. We look forward to updating you on future events for Riot Platforms. As always, you can contact us at ir@riot.inc for any other future questions, and we'll talk soon. Thank you.
Thank you for your participation. This does conclude the program, and you may now disconnect. Good day.
Okay.
All right, fellas.
Grab the old mic here.
Big earnings call for Riot. They beat the HPC drum a lot. They ducked some questions and addressed others a little more head on. Penny, quick recap of your thoughts.
Oh yeah, so I mean, I just looked at the numbers when they came out. It was in the presentation if you scroll all the way to the bottom, and I plugged them in just to see how it compared against what I was expecting. And their SG&A went up a lot, so that's concerning to me. Honestly, I was tuned out of the earnings call. I was somewhere else. So I don't know if they spoke to that or if anyone asked if, for guidance on that.
They did, and just to give our viewers some context here, as you calculated, Penny, and we're put in our private chat, you have 50.64 mil for cash-based SG&A, and that is up from, I believe, 36.4 mil in Q3. Now, Reggie Smith from JP Morgan, friend of the show, actually asked about that. And what Jason Less attributed it to, he said it was 22 million in Q4 in one-off expenses, for legal and litigation expenses regarding the Kentucky M&A sites, and then also stock-based advisory. So I think, you know, I would love to see the actual full, you know, financial filing, but that seems to make sense to me. 22 mil is pretty steep though for one-off
Okay, now
expenses.
that
But
I think that makes sense. So if you look at their adjusted EBITDA, where they net out things, they put 5.5 million for the total year for acquisition related costs, and that's normally something I exclude, but I guess I omitted it because they weren't. I don't think they had that there before. I guess they didn't have it. So that would, I guess I had to change my numbers and add, you know, subtract 5.5 million out of the SG&A and see what that turns up with.
But where's the other 17 mil coming from then? Do you know what I mean?
Well,
And
that's
just
the cash SG&As, yeah.
That's the full year too. I'm just curious because you're saying the 5.5 mil is acquisition related costs. We can maybe chalk that up to legal, but I wonder where they're couching the rest of it, because that's still a huge delta between the 22 mil that he said were one-off expenses.
He said 22 million of that was one-off for the full year.
Yeah. Oh, sorry, no, for Q4.
That's interesting.
Yeah. So something missing there, obviously, right?
Well, they didn't take it out of adjusted EBITDA. Not that I can see.
You
know what I mean?
Yeah, for sure. And can you explain to me what's going on with their adjusted EBITDA?
So you're looking at like slide 38 right now?
Yeah, it's the strangest EBITDA reporting I've seen from anyone.
No, that's pretty standard. So what they show at the top is the net income or loss. So that's like the full net of the statement of operations, like their
Right.
costs, their revenues, everything, cash, non-cash, everything to get to their bottom line. And then they say to get to our EBITDA, we're going to take out these things. So they're going to subtract out 27 million that they got from as interest, because that was an interest income. So they're saying, you know, interest doesn't count towards our adjusted EBITDA because it's not really from our operations. And they do the same with interest expense, the tax expense, and the depreciation. They say, you know, we don't count that towards EBITDA. And then that gets their EBITDA. And then they do a bunch of adjustments from that, which is basically taking out like non-cash related things like stock-based comp, and things that are one-offs or sort of not related to their ongoing business.
What I'm confused about, and maybe I'm just being an absolute moron here, is why is depreciation and amortization added?
Because to get from net income to EBITDA, which is earnings before interest, taxes, depreciation, and amortization, you have to take out depreciation and amortization. So all those things were included in the net income, and now they're just taking them out in those lines. So they're taking out depreciation and amortization by adding it back in. So in net income, it was negative 212 million, but they're adding 212 million back.
Okay.
But anyway, I hope that makes sense. But
I mean, it makes sense, but it doesn't make sense to me why you would be adding, like, you're adding depreciation and amortization here to the EBITDA. It's not in brackets,
no,
right?
You're adding it to net income to get to EBITDA. So let's say I had a business that I mined $1 million of Bitcoin and it cost me $1 million of power, and I had $2 million of depreciation. So my net income would be like negative 2 million or something, right? Because I got $1 million of Bitcoin, it cost me $1 million to mine it, and plus I had $2 million of depreciation. So my net income would be negative $2 million. And then to get it to EBITDA, I need to add back in the depreciation. So I say, okay, let's ignore the depreciation. I'm going to add back in the 2 million, and then my EBITDA would be 0, which is what you'd expect, right? I mined $1 million and it cost me $1 million.
Got it. Okay, I don't want to spend too much time on that. Thank you for.
Yeah, I apologize to the audience for this tangent.
No, you shouldn't apologize. I should be apologizing to the audience. I was the one who asked the question.
It was bad TV, guys. It was bad TV, but it's okay. I think most people listening to this are nerds, so it's totally okay.
So a few things I want to focus on, unless are there any other metrics, Penny, that you were honing in on that you wanted to talk about? Like you were mentioning looking at hash costs. I don't know if you crunched those numbers and other things.
Yeah, so I just tweeted on that, but again, I think I guess I overcounted SG&A because I didn't notice that adjustment. But their power costs seemed okay. It's sort of in line with last quarter. It's just I was concerned about the SG&A, and I'll take out that 5.5 million and see what it says. But I guess the larger story is, can they deliver on HPC or not? I mean, the stock's kind of been put through the ringer for a while now, and then they got that boost when they had the activist investors come on board, and now they've been punished again. So I don't know. I don't know what to make of it just yet.
Yeah, I mean, that was kind of the big story of the call, right? Is Jason Les was really beating on the drum of HPC and AI retrofits for, because you can't call it a retrofit, it's more of a brownfield for Corsicana. And there were a lot of words exchanged on that. Really quickly, just wanted to share this tweet from you. You said from Q3 to Q4 doesn't seem like much improvement in all on hash cost or dollar per kilowatt. Also didn't make much money from mining, 12 mil. SG&A costs increasing. We went over that. Power costs seem fine. Did edge up a bit from Q2 to Q3. Yeah. So going back to the HPC and AI thing, I have a few notes here. I think one of the most interesting parts of the call for me was the fact that if you look at their presentation, they completely revised their exahash forward guidance to 38.4 exahashes by end of year versus 46.7 exahashes in their Q3 presentation last year, which to me indicates that they're actually very serious about the Corsicana reboot into AI and HPC. And they had a number of questions about that. And one of them was from Reggie Smith, basically asking what's the timeline for that. And Jason kind of ducked that question because I don't think he wants to, put Riot into a corner to have to meet expectations that they might not be able to meet. But he also said, based on the demand and the quality of assets we have, we're optimistic about getting something done. And he said that if the right buyer came around, they would maybe even reboot the entire thing, the 400 megawatt section that is currently active and the 600 megawatt that they're still deploying substations for. And he also said the same thing about Rockdale, basically saying that nothing's off the table there in Texas. And it seems like they're going to be putting all of their hash rate eggs into the Kentucky basket going forward. It's like that's really like the only place for at least the next year that they are going to focus on expanding their hash rate. So that was the biggest takeaway for me, that just Riot actually seems pretty serious about an HPC and AI reboot.
Well, I guess we'll see if they can deliver. I don't know.
Right.
What was his answer to I heard one of the questions was like, it seems like there might be a lot less demand for that. What did he say to that?
He basically shrugged it off. And I think that was either a question that was harkening back to the DeepSeek stuff, which we actually covered on Blockspace a lot, and Wall Street kind of freaked out for no reason on that. But also Microsoft ducking out of a few contracts. And
it was the Microsoft thing.
Yeah, that was mostly the Microsoft thing. And he said that Microsoft already disputed a lot of the reports that said that they were doing this because of lack of demand. As far as I can tell from some of the conversations we've had with Bitcoin miners, it's like some of those contracts weren't very good to begin with. And so like Microsoft might be trying to duck out of them because it's not worth it. But
yeah, I'll jump in there and talk about that.
Yeah.
So the Microsoft thing this morning was interesting. TD Cohen, which is a stock analyst, kind of like the other guys we listened to on the stream earlier, they put out a note from their source checks, is kind of what they call them, stating that Microsoft had pulled back out of a few LOIs and other data center contracts that they were going to move forward with, and it amounted to hundreds of megawatts. And so they put this note out. It spooked the market Friday. Microsoft opened like a little bit lower. I mean, it's a huge stock, so like it's kind of like gold or Treasury. It's not necessarily going to move like that much, but enough to cause like concerns. It'd be interesting to people. And then pretty quickly afterwards, Microsoft spoke to Jeffries and refuted the note entirely from TD Cohen. So we obviously have like two different interpretations. Microsoft was saying on their side that these were just like some of the deals they're working on, right? Like they're a huge company and they plan on investing something like $80 billion into data centers over the foregoing future. And they have a 10-year time horizon on any sort of data center build. So like perhaps it was related, like perhaps they did move out of these sort of contracts, but it's also like expected because they're probably in negotiations with tons of different data centers and tons of different greenfields globally. And they probably shuffle things around all the time. The only thing that made it like somewhat interesting to me was like the Stargate project and the relationship there, since OpenAI, Oracle, SoftBank, and the U.S. government in some sort of capacity are all working together. And it does seem like there was probably going to be initially some OpenAI workloads sent to Microsoft Azure, and now it's not going to be. So that's kind of like the headline for the Microsoft thing this morning. We covered that in the newsletter. But for this Riot platform saying, it was one, funny to see an analyst bring it up after it was like pretty quickly debunked this morning, and two, for Jason really not to push back so hard on it. He's definitely not. He doesn't push as hard as like I say Iris Energy does or Irene
Yeah,
does.
like Dan Roberts during
calls.
their earnings call
Yeah.
was like, did not pull punches.
Jason's a little softer about these things, but yeah, the pushback was a little lighter. I think if you look at all these horizons, like all the numbers being thrown out there from the major banks, like, yeah, you don't have to take them all and be like, it's what's going to happen. But I think they're pretty good numbers to kind of lean into during an investor presentation. So looking at the stock price, you can kind of see that it just jumped around a lot during the presentation based on when he was talking about AI HPC. So the first part of the presentation there, it's the end of market hours, wasn't saying too much. And then he started talking about AI HPC and how they're going to grow out the facilities, pump back up, and then went back down a little bit when we talked about Bitcoin, and then finally went back up and kind of ended up basically flat. Riot obviously has been kind of languishing in like this $10 zone for a little bit, but so have a lot of other Bitcoin miners kind of not really catching a bid. So I don't see this as too interesting besides that. Obviously, the metrics you guys are talking about are certainly interesting, but for most Bitcoin miners, we're all kind of in the same crab bucket, right? Where like there's a few guys who kind of able to get out, like Core Scientific and a few other teams using like the AI narrative. But most everyone else is in the bucket. And the question is like, do you like being in there or do you not want to be in there? Pure play miners like Mara and CleanSpark.
I think most of them don't want to be in there anymore. I mean, part of the reason by taking one of these companies public in the first place was because you were doing something that the market wanted when companies weren't really doing it as much. Then we saw this Cambrian explosion in the last bull market of all these public miners, and now they're struggling to distinguish themselves. And
yeah, the other thing that was interesting to me on this, showing our newsletter right there, newsletter.blockspacemedia.com, is they said they had like nearly 800 employees. And if they're going to transition to AI HPC, like what does that look like? So a lot of their hires right now are engineers for building out Corsicana, building out these sites, and building out more of Rockdale. You don't need 800 employees to run that many megawatts. You need a decent amount of employees to run that many megawatts, but not 800. So I would assume that they kind of cycle out of these full-time employees into different ones over time, but that's quite an undertaking. And it seems like you'd probably rather just like have a deal where someone comes in and staffs it, and then you're basically just providing like the land, water, soil, and energy for the site.
Yeah,
but that's one thing I kind of noted.
Yeah, the 783 figure is crazy. I do think, obviously, to your point, though, Will, and you know this, like a lot of those are just contractors. I mean, he said full time, but a lot of those are probably contracted just to build out Corsicana and also the expansions at Kentucky. So how much of that is actually going to remain once these expansions or once if this retrofit, if it happens, ends up,
they're full time. Yeah. Riot orange pilling people by hiring them to build out data centers. So there is that. We do like that part. Probably one of the largest employers in Bitcoin itself, if you're not counting exchanges, which obviously hire a ton of people.
Definitely probably the biggest headcount for public miner.
Yeah, definitely for public miners.
And
yeah,
another thing I wanted to point out, and Penny, I'm curious your thoughts on this. We were actually talking about this before we hopped on the horn here about their other revenue, which is where they include their hosting segment. Their other revenue, and we don't have it totally broken out yet because I don't have the 10K in front of me. I don't know if they filed it yet, but they billed 17.165 mil for other revenue, and the cost of revenue was 31.8 million. So potentially these hosting contracts that they've had some trouble with are still bleeding them. I don't know if you have anything to add to that.
So I treat the other segment as sort of its self-contained hosting thing. So I mean, they made 4.6 million in revenue and they spent 9.2 on that. So they lost
for Q4 specifically.
Yeah, for Q4 specifically. So they lost like $4.5 million, which is, so let me see, that's pretty much in line with previous quarters. Q1 was negative 1.3, Q2 was negative 5.5, Q3 was negative 3.3, Q4 is negative 4.4. So it's kind of just, I don't know, cost of doing that hosting thing, whatever's going on there, which I presume they're still wrapped up in litigation about. So they haven't shut it down entirely, clearly.
Yeah, right. I mean, a lot of these are hosting contracts that Riot inherited when it purchased Windstone. One of these was with GMO, the Japanese internet company, and the hosting contract for that was abysmal for Riot. It's really good for GMO, but it was something in the ballpark of 1 or 2 cents per kilowatt hour. And GMO, up until the point where they were kicked out, they were still running like S9s. They got kicked out, I think, in 2023. And I don't know what the update is on that. In their last, I think in their Q3 filings, they said that litigation was still ongoing. And of course, they also have this litigation ongoing with Rhodium. There was a decision handed down recently where a judge basically said that Rhodium had 2 contracts that were valid, right? So like Rhodium rewrote a contract with Windstone before Riot purchased it. And the judge said that the rewrite does not supersede the original contract. So that's also still ongoing currently. There's a lot of litigation on these things, and it's kind of unclear to me just which hosting contracts are still being totally adhered to. But needless to say, to your point there, Penny, they've just been bleeding on these hosting segments. And I think that's something that it would be nice to see them get out of if I was a Riot holder, because that's just a a cash sink for the company, both in legal expenses and in the fact that you're losing money on those hosting contracts.
Yeah, I'm actually wondering where the legal expenses are. I assume they're in SG&A, but they don't break it out in adjusted EBITDA. So other companies typically do that because it's not like an operating business related thing. So maybe that's why SG&A, maybe they had more legal bills in Q4 than in Q3. I don't know. But I did rerun the numbers, giving them that the $2.5 million was acquisition related costs. So if you take that out of SG&A, it's still an increase quarter over quarter on like any basis. So like on hash cost, it went from $18.80 to $20.35. And on a per kilowatt hour basis, it went from like 3 cents to 3.7 cents. So I would be concerned about their costs rising. But of course, the standard disclaimer applies. If Bitcoin rips, then their costs are going to stay flat, but hash price can go up unlimited amount. So if they shave a penny, or if they pay a penny or two more for whatever costs versus other miners, in very bullish scenarios, it doesn't matter much because the margins just blow up.
What was the hash cost again? Sorry, I missed that.
So for SG&A, I just look at the SG&A costs, minus the stock-based compensation and minus whatever write-offs. And so far, the only write-off I see is the acquisition-related costs. I don't see a separate itemization for legal costs like some other companies have. But in Q3, so in Q1, that was $30.62 as a hash cost. And then it went to about $27 in Q2, and it went to about $19 in Q3. And then now it went up to 20. So you would expect that, like, as they scale larger, their SG&A costs might stay flat, but they just throw in more hash rate. But that doesn't seem to happen. It seems like they threw on more hash rate and took on more SG&A costs in roughly equivalent proportions.
And that's hash cost just for their SG&A. Do you have it all in with the electricity costs as well? I mean,
Yeah, sure. Right. So I posted this. It came to about $48.
Okay, yeah, that's pretty high. I mean, hash price right now is at like what, $55, $56 per petahash per day.
So last quarter it was like 47 and 86. So it went up like 50 cents. But again, you'd expect it to go down if they're like growing into an economy of scale.
Right.
So I could be something like, they didn't itemize what SG&A costs you might like want to exclude. like legal expenses maybe went up a lot in Q4, but it's still a pretty high number. I mean, that hash cost is still a pretty high number compared to everyone else. I think only Mara is worse.
Yeah, 100%. It would be interesting if we could get some clarity on where those legal expenses are, because Riot is battling multiple lawsuits right now, or I should just say litigation, right? They're locked in these kind of years-long disputes with other companies. They also have the litigation for the M&A for the Kentucky facilities. And there's probably a reason they don't want to put that in there, because it's probably a pretty fat bill, right? And they just don't want to have to explain why this keeps happening to their
Well,
shareholders.
but it would be better for them to explain it so you could see that it's not an expense
Sure.
for their mining operations. So to put their all-in cost in perspective, so it was like 48. Iron came out with like 24.55, so almost half, or almost a full like $20 per petahash per second per day improvement, which is just insane. Like that's like as if Bitcoin went up 50% overnight. Like in terms of how much money on a per hash rate basis Iron is making versus Riot.
That's
And
nuts.
CleanSpark came in at around 35, 36. So you go from what was it, 25 to 35, and then Riot's sitting at 48. So it's kind of rough.
Yeah, that is pretty rough. Well, maybe HPC and AI will breathe a new life into the company. I do think that is the thing to keep an eye on. And, obviously a huge gamble. Riot could spend the next few months evaluating this and then decide that it's not worth it and then want to outfit it. They could spend the next few years actually trying to retrofit to AI, and then maybe it doesn't pan out the way that they want it to. This is a still complete unknown for Bitcoin miners, whether or not this is going to pan out for them, because it's never been done before. So that would be my biggest question as I've ever held Riot. What were you saying, Penny?
This is Will over here with the smooth brain analysis. What a bullish case for Riot here is they get a bid from a hyperscaler who's really interested in this, which probably be a lot of work. But they assembled some people to do that, and then they can keep growing their Bitcoin mining operations in Kentucky, I believe it is. So like you do have a nice dual strategy there. Like there's obviously the concerns with like they don't seem to be able to get their SG&A under control, hash cost is high, uptime is rough, a few things like that. There's also concerns like the employment side. I hear all those things, but I'd love to hear from you guys, maybe Penny, like what are some of the bull scenarios here that make this like a little more interesting, or where's the good light here for this situation?
Well, optimistically they have plenty of room to improve. So they can lower their SG&A costs, or they can throw on, they don't have to lower their SG&A costs, but they can throw on lots of hash rate without increasing their SG&A. Their power costs seem like okay. Their direct power cost is like 4 cents. They have some indirect power costs there, which is about another penny. So I think the bull case is, well, there's two things. First of all, I haven't looked at the share price like on a per exahash basis. So like their enterprise value to exahash, you take out all the Bitcoin they hold or whatever, maybe their hash rate is going for very cheap on the market already. So maybe it's priced in, like this performance is being priced in already. So if you're talking about upside to share price, maybe if they improve things, their share price goes up. They can improve the costs. Like I said, they can throw in more hash rate without increasing SG&A too much, or maybe they could explain which parts of SG&A might go away, within a year or two, or however long litigation takes or whatever. The power costs are okay. I don't know. It would just be, and then there's just Bitcoin on its own could go up. So they're in the same boat as everyone else in that respect.
That was so funny though. And everything can get better. I guess I only found that funny. That's okay.
Yeah, room for improvement, man. The glass is half full.
That was funny.
I think the bullish case is that if the HPC and AI thing really does pan out, then they can really cash in on what is prime real estate, right? I mean, as Jason pointed out in the call, their Corsicana site is close to, it's Dallas, right? Or is it Houston? Which they're all the same to me in my head, all these big ass Texas cities. I believe he said Dallas. But then that makes it perfect for building a data center for inference, right? Which is specifically like using AI and HPC models versus training them. You need to be closer to population centers for that to be more viable so that you don't have as much latency. And also just if this, I don't know what kind of deal structure they'll do, like, right, will they just sell the site entirely? Will they partner with someone like CoreWeave and just have them as a tenant, or partner with someone like Core Scientific is doing with CoreWeave and just have them as a tenant? But theoretically, like the upside for HPC and AI is much higher than Bitcoin mining. Penny's done a lot of good analysis on this, but like your dollar per megawatt revenue is exponentially higher and could only be increasing, whereas like Bitcoin mining revenue with hash price is just getting compressed year over year.
Yeah, so that's a great point. I feel dumb for not mentioned HPC. I guess it's because I have a spreadsheet with like only mining numbers all over it. But if you take into account that their stock might be discounted on a hash rate basis, or for they're being discounted because their mining operations aren't as competitive as their peers, then that might not apply to HPC at all. So you could say there's some bigger upside there, similar to Core Scientific, I guess. If they were just viewed as being bankrupt and their hash rate worth nothing, and then suddenly they found a way to make a lot more money from it, from the megawatts. So there could be some upside there. I'm curious to see what happens with this whole HPC thing.
Yeah,
it certainly was not an enjoyable day for me as a Core Scientific holder.
It really is just the biggest question mark for all these miners, because we've said it a lot on the show, but it bears repeating. If you actually look at the power assets that are available, and if you look at the generation capacity that is projected to come online over the next few years, it's abysmal in the US. Like, we have over prioritized renewables and we have not prioritized base loads for like the last decade. And now a lot of grids are completely ill-equipped to handle demand from HPC and AI should it actually hit the base case or the upper bound of demand that analysts project, right? I had a great conversation with Haley Thompson from Luxor about this. We'll be releasing that show in the next week or two. But you just like crunch the numbers, and there are not enough electrons to go around for this compute, assuming it actually ends up being as popular as people think it will be. So I almost think that it's inevitable that the Riots of the world and these miners with multi-hundred megawatt blocks end up just partnering with hyperscalers, HPC companies, or selling the assets entirely. Because like everyone has their price, right? And at a certain point, what's better for the shareholders and also just the company insiders, trying to slog it away with Bitcoin mining or selling a site for several magnitudes more than what you've put into it. So
yeah, and as if regular Bitcoin volatility wasn't enough, or sentiment on Bitcoin mining wasn't enough, and like network hash rate wasn't enough, as if that wasn't enough volatility, now it's like HPC is it's like just as much volatile every day. There's something new now with like, oh, we're not going to need as much megawatts as before, or now we're going to need more, or it's actually going to increase demand, not decrease. Like it's just all over the place. So Bitcoin mining is at the intersection of a lot of these things. So I could understand if investors are frustrated or holding onto their seats.
Yeah, we're all like kind of groping around in the darkness, trying to figure out if there's actually an exit, right? Because like you said,
yeah, that
all
too.
This what's up?
Yeah, that too. It's like, and what about the whole Bitcoin cycle thing? Did we top this cycle? I don't think so. But if we did, that's not great.
No, yeah, especially not for
So
these
it's sort of like as time goes on, if Bitcoin stayed flat for like another 6 months, I think that worry would start to set in more and more. So it's sort of like
100%.
there's like a lot of this timing stuff where things are trying to be priced in, but these things that are getting priced in are like extremely volatile. It's Bitcoin and it's that cycle and now it's HPC.
Yeah, and a complete unknown with actual impact of HPC and AI, to your point. I mean, like comparing it to the dot-com bubble, I think is not totally fair, obviously, because back then you had completely speculative use cases for websites that didn't actually deliver any products. Right now, obviously, we have multiple large language models that are transforming commerce and workflows across a number of industries, right? But it is kind of TBD, like how much value will these tools help companies accrue, right? And like how much will
Yeah,
they
that's
save?
exactly it.
Yeah, what will they cost in other places?
because all of that value, if there's a huge amount of value there, like trillions, that trickles down to the stocks that we're talking about by way of like higher fees for leasing their megawatts. So it's like it's like very tied to AI in that sense. And I still think it's very speculative how much economic benefit AI will produce. And I don't mean speculative like I'm skeptical, just what the exact number is and what the timeline is. And like a lot of your investments in .com stuff would have been fine if you bought the right stocks and wrote it out. Most of them didn't. It might play out the same way there. Like every company, last year, any company talking about AI, I'm sure you saw like the number of times AI was spoken to per quarter for like various companies. Like you speak to AI, you get a bump, but like, can you actually deliver economic benefit from that? Certainly someone will. I'm pretty certain of that. It's just who's going to do it and like at what magnitude and what's the timeline going to be.
The timeline's the biggest question, I think, and the next year or two, I think, will give us especially some insights into just how feasible a lot of the stuff is, like Core's retrofit, and whether or not Riot ends up pursuing this with Corsicana. And I also think, dropping a little teaser here, you're going to see other big miners come out with news in the coming weeks with regards to this HPC stuff. I do think there's an opportunity cost here, kind of to piggyback on what you're saying, Penny. You almost want to get in now and try to cash in before the uncertainty becomes certain, and then you might not have as much, to bargain with later, right? There's still all of this hype around it, and if you can actually monetize your assets now versus maybe wait, maybe you don't actually have as much upside now as if you wait, but maybe you have more, right? If all of this ends up being fizzling out and being not as impressive as people think. So plenty to chew on.
So what's your prediction? You think there's going to be some big news soon. What do you think?
I'm not going to name names, but I think that you're going to see other Bitcoin miners, maybe around their earnings, I think probably make some announcements about some
Who's
forays.
left? Who's left? Who's left? There's only like CleanSpark and Mara. I guess I don't follow a bunch, like I don't really follow Hive too closely, but
we'll talk off chat.
All right.
Follow Blockspace to get
follow
all the
Blockspace
news.
For also just a few plugs here. I will have to say, listeners of Blockspace who listened to Reggie Smith's episode with us a few months ago had the deets on the Corsicana stuff before any of this happened. So shameless shill, a little bit of a plug there. And if you had listened to our show with Penny on Riot's Q3 earnings last year, you would have had the scoop on rising SG&A and a lot of these other metrics that he kept his eyes on. So all that being said, if you're a new listener here, please like and subscribe this on YouTube. Go give us a listen on all of our other podcasts. Subscribe to us at The Mining Pod and at Blockspace Pod on Twitter. And check out our newsletter at newsletter.blockspacemedia.com. And follow your boy Penny Ether over here at Penny Ether on Twitter.
We'll be here on Wednesday as well.
Well,
I won't be.
Penny_Ether, excuse me, on Twitter. Will you be joining us for Mara on Wednesday, Penny? No pressure.
Probably. I mean, they're like one of my favorite companies to watch.
I will not be. I will be at ETH Denver shilling ETH tokens. Just kidding. Spreading the good word of Bitcoin there.
All right, gents, any other things that stood out from this earnings call that we didn't touch on? Nothing?
Wait, by the way, isn't Core Scientific on Wednesday too?
Are they?
Yeah, they are.
Oh man, really?
Yeah, I might have to just, I'll do the numbers for Mara, but I'm going to be watching Core Scientific for sure.
Well, wait, or do they? Don't tell me they overlap.
I think they're both Wednesday after market.
Very, very lame.
Oh, dude, that blows.
So I mean, do you want to hear about HPC or do you want to hear about heating homes in Norway? or windmills, or you can hear
windmills
about
are sick.
Yeah, they're gonna have very super low cost of energy on.
Yeah, windmills are super cool, dude.
Tiny fraction.
Let's do a poll right now. I'll tweet it out on the Mining Pod Twitter account. Which one?
Employing energy producing technology that's been used since the 17th century is super dope. Yeah, that's going to be a tough one. Kind of leaning towards Core, Penny, because I know they're your baby. And
It's whatever the audience wants, you know.
this is true. Let them eat HPC. I kind of wish we could do them both at the same time.
There might be a way.
You can like route each one to a separate channel. Like
Yeah,
left
I
and
think
right.
that might like hop on.
No, just have everyone on their headphones, and they just have to listen with like their left half of the brain to one of them, and their right half of the brain to the other.
We
Something like
just
that.
get Fred and Adam on the same call.
I would love that. We need to do like public miner CEO fight nights.
I have a good
Ooh.
idea actually. So you guys should do a bingo card while we're watching. You know, we're watching and listening to the earnings call, and you guys just like have that bingo card there, and you fill it out.
That's
We could also do
hilarious.
we should do a boxing night at Bitcoin Vegas between all the different mining stock CEOs.
Like a whole tournament. That'd be awesome.
Yeah.
Who's your money on?
Jason's pretty
Jason.
big.
I would go with Jason.
Jason and Sully are both pretty stout guys.
Yeah, they're both pretty big.
Although if you got Russell Kahn in there from Core,
one vote
that would be that would. I mean, he's not a CEO, but that would be my bet. Okay, we'll
boys,
try to figure out.
I got to
how
wrap
do
up
both
here.
of these. I honestly might do what you said, Penny, and like route one to block space and route the other to mining pod, and then we'll probably just cover one, but let people listen into the other one.
Whatever you want to do.
Yeah.
I'm just gonna look at the release for Mara and listen and look at the release for Cores and then listen to Cores. Maybe their calls are like offset by half an hour or something. I don't know.
Yeah, we'll see. I think they're both at 4:30, but
all right, guys, it's been a pleasure.
Yep, Penny, thanks for joining, man. We'll see you on Wednesday. And for all of our listeners and viewers, thank you for tuning in. Stick around on Wednesday. We'll be doing one or both of Core and Mara. We'll let you know on the pod handle when we figure it out. But
by the way, Cypher's tomorrow.
Yeah, they're early in the morning though. I'm not
Okay.
getting up for that.
Oh yeah, I agree.
Yeah, I'm PST. I can't get up at 5 for earnings calls. But
all right,
good
guys.
for them.
Thanks,
Anyway,
audience. Thanks for tuning in.
See you guys.
Take it easy, y'all.